This presentation is really geared towards the Tesla community. One thing that the Tesla community has been phenomenal at is crowdsourcing research on, production, on estimates, on deliveries, on, products and roadmaps and margins and financials. It's been awesome. But one thing that I think is lacking today is a little bit of that type of crowdsourced research on macro conditions. We spend, most of our time talking Tesla specifics, which is good, which is how it should be. Most of our time should be focused on fundamentals and not so much worrying about macro. But I think the goal of this presentation is just to make everybody in the Tesla community aware of certain things that I see that are deteriorating in the macro economy that might affect Tesla in the short to medium run.
So Mayur's going to tell us some news that we don't want to hear, but we, as investors, we need to stay open-minded and curious, be willing to change our minds. Doesn't mean we need to make any changes with our investments. He's Mayur Thaker, equity strategist at Zacks Investment Research. I'm Bradford Ferguson with Rebellionaire.com, and we're going to get right into it. Go ahead and share your presentation, Mayur.
Yeah, so that's important what you just said. This is by no means a solicitation or a recommendation to sell any securities that you have. That's not what my goal is. My goal here is just to inform why I believe the US is entering recession. So there's these 7 broad categories of economics or economic measurements that are the reason why I am bearish on the macro scene for the foreseeable future. One is manufacturing. We know about the inverted yield curve. The other is an index that is quite well known within the macro financial community, but maybe lesser known within the Tesla community, which is the leading economic index. This is published by the Conference Board. They are a leading macro research, group that publishes a number of different indicators. Probably the most popular one is the LEI. We'll talk about that. I believe there's also worrisome trends in excess savings that has implications on retail sales and spending. Cyclical GDP. This is very important to distinguish from aggregate GDP, which is what gets all the headlines. But if you look beneath the surface, I believe that there are problems that are building that typically only show up during or just before recessions. Employment is another thing. We usually just hear the headline numbers, great job gains all throughout 2023. But if you look at the leading indicators of employment, those are showing worrisome signs. And then lastly, credit. Credit is the lifeblood of commerce and growth. And we are currently seeing credit contraction, which again typically only happens in and around recessions. And lastly, unlike past market environments, the Fed right now is not supportive of stocks or bonds right now. And they won't be until we see a sizable market decline. Because right now the Fed is focused on one thing, which is taming inflation. That's been the number 1, number 2, and number 3 goals of the Fed these past 1.5 years, is to get inflation back under control. And I believe Jay Powell has made it very clear that he is not afraid of recession if it means that it gets the inflation genie, back into the bottle. And that's what I believe he is willing to risk in order to get to, their mandate, which is to get stable inflation, stable prices.
One of the things that Mayur might be referring to is the Fed has literally been sucking the liquidity out of the financial system. So they're letting their bonds run off, right? And when they do that, cash comes out of the system. So this is true that the Fed is not supporting liquidity right now, and that's there's talk that that's going to be one of the first actions that the Fed takes, is to back off of that schedule. The Fed and the whoever else is involved with the Treasury.
Yeah, yeah, exactly. So that's been exactly what their mission has been these past 1.5 years, and I believe Jay Powell has been very consistent and clear on that. That he's not interested in maintaining liquidity right now. Right now, the
Mhm.
goal is to get inflation down,
Yeah.
and he's not afraid of creating a bear market in stocks to achieve that goal.
Yep.
So, one of the reasons why I think this is happening again is it's Fed engineered. Um, they know what they're doing. So after they've raised rates since early 2023 or early 2022, I should say, um, we now have real yields. So this is adjusted for inflation expectations at 2%, and 2% doesn't seem like it's very high, but this is a real yield, not nominal, but adjusted for inflation. The 10-year real yield has now hit 2%. This is the highest level in 20 years. So for the first time in 20 years, companies across the board are now facing a very real choice, which is that do they continue with capex, with planned capex, or do they take a step back and not take risk and simply park excess cash in treasuries? Remember, when the cost of capital rises, at the margin, it makes many capex decisions uneconomic. Now, this is not the case for Tesla. So this is not, I'm not talking about Tesla specifically, since
Hmm.
Tesla generates incredible ROIC. We've talked about that, over the years, and they still do even now. Despite margins coming down, they still have ROIC well in the upper teens. So it's well in excess of, these yields that we see here, but that's not the case for all companies. So at the margin, I'm talking from a big picture macro scenario. An increase in real yields at the margin makes capex less attractive for many companies that generate low ROIC. So in those situations, companies will taper back on capex. And actually, there's another chart that I tweeted out, but I unfortunately don't have it in this deck here.
Hmm.
But it actually shows exactly that expected capex. This was published by Bloomberg and another group that created the chart on Bloomberg. But they show that planned capex for this year has hit lows that we don't typically see outside of recessions in terms of year-over-year growth rates in planned capex. So this is exactly what I expected would happen. With a increase in the cost of capital at the margin, capex should get hit because not everybody generates attractive returns on invested capital like Tesla. So at the margin, that means that S&P earnings will go down because as companies cut back on capex, what does that actually mean? It means lost revenue for somebody else. And so that triggers a domino effect where those companies have to cut back on their capex. And then at some point, those companies have to lay off, some percentage of their staff. And that's what we're starting to see right now. It's still in the early stages of that happening, but I'll show you exactly why I think it is happening in the labor market as well. But this right here is the trigger of all of this that we're talking about. A sharply higher cost of capital, which increases the hurdle rate that makes decisions either economic or uneconomic. So at the
Hmm.
margin, an increase is going to lead to cuts in capex for the S&P 500 as a whole.
And I realize hiring is not capex, but we've seen. I don't know if it's a rumor, but allegedly Google's going to be cutting 30,000 jobs. Maybe they overhired during the crisis and are working with teams that are too big, and that causes an inefficiency. But um, I feel like some of these stories have been somewhat ignored by the media and investors.
Yeah. Yeah, exactly. And well, so I guess it was kind of ignored for a good reason. So, to the bulls' point of view, which they have been correct, which is that even though we've seen announced layoffs, till now, those people that were laid off were able to find work relatively quickly.
Mm-hmm.
So, and you can see that by looking at the difference between the initial claims for unemployment insurance and
Yeah.
continuing claims for unemployment insurance. So,
Mm-hmm.
initial claims spiked last year as people were laid off and so on, but continuing claims never really rose significantly, which basically tells you that although they got laid off, they were able to find new work relatively quickly. Um, so that has really been the story for 2023. However, that is starting to change now. So we'll look at that. Um, but the next area that I think is very, very important and cannot be ignored is what's happening in manufacturing. So the ISM manufacturing PMI is, probably the most important gauge for manufacturing activity and production in the United States, and that's been in contraction now for 13 consecutive months. So you can see, that this number doesn't stay in contraction for very long during bull markets. During times of economic expansion, it might drop into contraction briefly like it did in 2015, but it never stays in a prolonged contraction outside of recessions. So right now it's very consistent with what typically happens in recession. So we
Mm-hmm.
saw that it entered contraction in the early part of 2008, and it stayed that way until the bottom really fell out. As we had massive bank failures back then. Same thing happened in 2000, 2001 during that recession, and here we are today. So it's been 13 consecutive months. And the other thing that I have on this chart overlaid is the chart of year-over-year S&P earnings growth. And as you can see, manufacturing shares a very strong correlation, a leading correlation to S&P earnings growth expectations. Um, the correlation here doesn't show it here on this chart, but the correlation is 70%, the correlation coefficient. So that's a relatively high correlation, which makes sense
Mm-hmm.
because manufacturing is still very, very important. And now what we're seeing, and if we zoom into the most recent, last 2 years, now we're starting to see a divergence between what analysts are expecting for the S&P 500 earnings growth this year, which is roughly 10% year
Yeah.
over year. But you're seeing a bearish divergence from the manufacturing PMI. Typically, you never see earnings expansion without the assistance of manufacturing expansion.
So
So
I,
even,
I want to push back a little bit on this one, Mayur. Allegedly, and I think this was maybe 5 years ago, we got down to manufacturing being like 11% of the US economy or lower. Um, do you think the fact that it seems like tech is driving a lot of our productivity gains and that our economy is 70% service oriented? I might be wrong on some of these stats, but um, do you think that lends some credence that we don't quite follow this one, or what are your thoughts on those two
I
issues?
think you're generally right. You're probably in the ballpark. Manufacturing is probably only 10 to 12% of US GDP.
Mm-hmm.
Um, but it's not so much the size in terms of like market, the share of GDP. It's more so the direction and therefore the correlation manufacturing has with the S&P earnings overall.
Mm-hmm.
So this manufacturing may be in a downward sloping trajectory. As most manufacturing has shifted overseas, but we're still in the business of manufacturing high tech things. So manufacturing has left for most simple things,
Mm,
but many big ticket items are still manufactured here in the US.
okay.
So it's not so much the size of manufacturing, but more so its continued correlation in directionally speaking of S&P earnings growth or contraction.
Hmm. Okay.
And that's why you see it even in recent years, going back maybe not 20 years ago, but certainly over the last 5 years, you can still see that that relationship holds. Whereas manufacturing contracts, so does the S&P earnings. As manufacturing expands, so do S&P earnings. And I think that this time is no different. So we just got the
Mm,
update for December last week, and it once again, posted its 13th consecutive month of contraction. So I believe that if we get another month, of negative manufacturing PMIs here, I think that's going to start to weigh on earnings expectations for this year. Because so far, as you can see from this orange line, um, analysts are still very bullish on earnings for this year. They're expecting 10% earnings growth. But
mm,
I think that that number is going to be marked down quite significantly
okay.
as we see time go on. Just as we saw, 2023 get marked down. At the start of 2023, analysts were similarly bullish, expecting 10% earnings growth. That was revised down to zero by the end of the year. So 2023 was basically a lost year for earnings. There was no earnings growth for the S&P last year. And then now for Q4 specifically, I don't have the chart in front of me, but I can just tell you the numbers. 3 months ago, analysts were expecting 5.5% earnings growth year over year for Q4. This is for the S&P overall. That's now been revised to zero. So these earnings are evaporating as time goes on and as further data is revealed. But analysts have not yet marked down 2024 numbers. So they're marking it down as the quarters come and go. But they haven't started, really knocking down the 2024 numbers. But I think it's just a matter of time. So I think if we just get maybe one more month of negative manufacturing, then and then we'll see exactly how Q4 earnings season goes starting next week or 2 weeks
Hmm.
from now. But I believe that the trends are negative. Again, cost of capital, trends in manufacturing, and then all these other trends that I'm going to show in this slide deck.
Hmm.
Directionally speaking, at the margin, it's bearish for earnings. So I
Let,
believe that we're going to see
uh,
that wave of
so my
cuts.
question, my question here, Mayur, would be: we had supply chain issues, and now that supply chain is caught up, the corporate world is going to reap those profits. So maybe it makes sense that earnings are going to be better for a bit before that plateaus a little bit. Maybe this divergence makes sense.
And that's the expectation. That
Mm,
that's the expectation. And right now, that's the consensus. Um, right now, the market's at almost a 20 PE right now, and that's
yeah,
on
that's
this,
high.
and that's high, and that's on this expectation of a strong earnings recovery. So it's
Hmm.
20 times those elevated earnings expectations for this year.
Hmm.
So I believe that that's the consensus. So this is one of the main reasons for this presentation is that we're priced for a bullish recovery in earnings, but the leading indicators of earnings, such as ISM manufacturing,
Hmm.
are moving in a different direction.
Okay.
So that's why I think that there's risk to analyst expectations for 2024. Um, if you look at, like, say, for example, subcomponents of the ISM manufacturing PMI, such as the new orders index, That's at recessionary levels. This is a proxy for industrial demand. We don't get to these levels outside recessions. As you can see on this chart, this is, so, with sluggish demand, uh, here's another gauge, by the way. This is a regional index, the Philly Fed Index. That's also in contraction. And anytime this has gotten to a reading of minus 25 or lower, we've been in a recession or about to enter a recession, as you see right here. And that was triggered, late last year. So either we're entering a recession or this time is different for all of these together simultaneously. So again, as we see weakening new orders, factories are already cutting the work week. So here we see, pretty much the lowest factory work week hours since, the 2008, 2009. It's typically not the case if we're in an economic expansionary period to have, work week hours this low. Now, yeah, AI is coming. It's going to displace workers. That's happening. I mean, that's going to happen. But it hasn't happened yet in a meaningful way. So, this decline in the work week, I don't think is attributable to AI just yet. So this is actual factories cutting work week hours because of sluggish demand, as we see from this new orders index. Again, the work week is at recession levels. Then we have the inverted yield curve. This is well published and widely talked about. But I wouldn't bet against this because the 10-year yield minus the 2-year yield has correctly predicted, each of the last, 1, 2, 3, 4, 5, even further, 6 recessions. With a lead time of somewhere between 12 to 18 months. And we're now at month number 16, I believe, in terms of inversion. So we're basically right on time. Typically recessions follow in that sort of sequence 12 to 18 months after the inversion occurs. So we're right around that threshold now. So that's why I think that it's getting risky to be long stocks, especially when the markets are priced for a robust earnings recovery. While all of these other leading indicators are flashing warnings. And so I just don't believe that this time is any different.
Can you go back to that? I want to help people put on their own economist hat here. So your mouse is around like the year 2000. So what you see is that number is declining over time and it's hitting a low. And then there's this delay of maybe it's around 18 months or so. And it during those 18 months, it goes to a point where it uninverts, but
Yes.
that the recession starts anyways. So this is how recessions tend to develop with yield curves, and you see it again in 07. The yield curve inverted, then we had a delay. We see it again in the late 80s. Also in the 70s, there wasn't much of delay there. But we see it getting even more inverted this time than it did in 07 or in year 2000, and we haven't had the recession yet. So I think this chart's pretty interesting and very compelling.
Yeah. Yeah. And yeah, that's an important observation, is that just when things are about to start getting really rocky is when you see that re-steepening of the yield curve there. So I think that has started to occur. We almost got to zero until it, really took a U-turn and went back negative. But overall, just while we're in inversion, I think it's extremely risky to be long stocks, especially if stocks are not priced for a recession, and in fact, it's the exact opposite. So that's the risk, is that the expectation that's built into the market today is for a robust earnings recovery led by a soft landing, which is basically, the Fed, getting inflation down while avoiding recession. That's currently the consensus. If you were to ask me, looking at a 20 PE on the S&P, which, by the way, like I said, we didn't have earnings growth last year at all, and yet we're at a 20 PE based on expectations of an optimistic 2024.
Yeah.
But again, leading indicators of earnings are suggesting that that is going to be revised down.
And I think maybe people got a little burnout because everyone was calling for recession the start of last year, and no recession happened. So people are thinking now everything's okay, and you weren't calling for a recession at the beginning of last year, right?
Actually, I was. So I was one of those people.
Okay. And,
Now,
and when did you think it would happen, or what did you think the implications were going to be back then?
So I floated the idea around just about a year ago. In fact, last January 2023. But I wasn't talking about it too much because at the time markets were in free fall and Tesla was down to $105 a share.
Right.
So I thought that the recession was, even if it did occur, it was pretty close to being priced in, especially into tech. So, I was spending most of my time focused on Tesla and buying that dip, which ended up being a great idea. So I didn't talk about it much, but I did start talking about it a lot more starting around June of last year. Because again,
as these months from inversion go on, your spidey sense needs to be picking up, and that's what Mayur and I, what we do professionally is investing. So like all we do is investing. It's not a hobby for us. So let's go ahead and move on to the next one, Mayur.
Yeah, so this is again a chart of a similar idea, but it's now a chart of the Fed funds rate versus the 2-year yield. Again, this tells me, my interpretation is that the bond market thinks that rates are too high. So I actually agree with Elon, who thinks that interest rates are too high right now, given where the economy is and where leading economic indicators are moving towards. I think the Fed is throttling the economy in order to get inflation down. And we see that from this chart, which is the 2-year yield, which is still a very short-term yield. This should not be inverted as much as it is. And that means that I believe bond market participants think that the Fed is a little too aggressive with where we're at, in terms of the Fed funds rate. So again, history has shown that forced inversion breaks things. So it does lead to recessions because, as soon as we get here, we're excessively restrictive, and it makes, lending difficult and, cost of capital high, which again leads to all sorts of decisions at the margin that hurt growth.
I want to be clear about something, that there's this perception that the Fed doesn't know what's going on. You only have to read the Fed minutes once to understand that the Fed knows what's happening. They have a lot of people looking at the economy. They do all these surveys where they talk to business leaders. The Fed knows what's going on. They know what's going on with leading economic indicators. I'm really curious to see what the Fed does from here, because when Jay Powell came out very strongly, it's around August or September of 2022. And he basically said, we want to hurt the economy to set ourselves up for the next 10-year bull market, or, what would it be called? Expansion, for the next 10, 15-year expansion. He said he wanted to hurt real estate, and he wanted to hurt employment. I don't think the Fed's necessarily going to step in and save us or whatever if
Yeah.
we start to get these negative indicators. What are your thoughts here, Mayur? I think the Fed's going to be late to lower rates based off of the hopefulness or versus the hopefulness in the Fed funds futures market, where people are predicting they're going to lower by like March or whatever. Um, I think the Fed's going to move slower than people want. Typically committees move at the pace of the person who doesn't want to do what the committee wants to do. Like that group slows the committee down from taking the action that they probably should be taking.
Yeah.
What are your thoughts with like how the Fed's going to juggle these? I know we're getting high into the speculation area, but curious.
Yeah. So the market got really excited as soon as we got, I think it was the November or October CPI, and it came in below expectations, and that led to this massive rally
Mm-hmm.
into year end, um, because now the market expects the Fed to be cutting rates, 5, 6 times next year. I think that the market has gotten way ahead of itself because the Fed has never indicated that they're going to be cutting that often next year. By the way, if they cut 6 times, even if they did cut 6 times next year, that would be for the wrong reasons, and that's not bullish.
Yeah.
They're not. If they're going to cut that rapidly, that only happens during times of economic emergencies. So that's not what we should be really actually aiming for, is rapid cuts to the Fed funds rate.
Yeah. And
Um,
Mayur's chuckling. He's like me. He chuckles at things that are painful. He's just kind of thinking about the reality of the situation if the Fed were to do that. I'm kind of the same way.
yeah, right, exactly. So I think that the market has gotten way ahead of itself. Um, if we don't have recession, if we don't see a meaningful uptick in unemployment,
Mm-hmm.
then the Fed is not going to be cutting rates that dramatically.
Mm-hmm.
Um, and if they do cut rates that dramatically, it'll be in response to significant deterioration in liquidity and in the economy.
Mm-hmm.
So, I just don't see a bullish scenario. Right now the expectation is a soft landing, right? So inflation, eases nicely down to 2%, but never, goes too far beyond that, because, beyond that would mean deflation, which only happens in recession. That's the expectation. Now, the number of times that that's happened is few and far in between. We've never had soft landings, that, every time we've had a aggressive tightening cycle, we've led to a recession,
Mm-hmm.
especially when leading economic indicators are telling us so.
Yeah.
But right now, the expectation is for a soft landing where earnings can rebound and inflation can come
Mm-hmm.
back to the Fed's goal of 2% without triggering high unemployment. That's threading a needle that is exceptionally difficult to do, and the Fed doesn't have a history of being able to do that, especially when, again, leading economic indicators are pointing to recession because they're in contraction. This is a very dangerous
Yeah.
bet to be making,
I
and
think
that's what
that
the market is
I think
waiting.
Jerome Powell and Janet Yellen would be like sainted or knighted
Yeah,
if they manage a soft landing here. Let's go ahead and go to the next one, Mayur.
yeah. So typically, because my thesis is recession, traditionally it would drive long-term yields lower. However, this time could be different, because there is massive Treasury issuance that's coming up. Some 30% of all U.S. government debt outstanding is set to mature in the next year. and they're going to have to refinance at much higher borrowing costs because those 10-year treasuries that were issued 10 years ago were done at 2% or less,
Mhm.
um, and now they're going to have to refi at 4%. So, and right now the government is already in a massive deficit, $2 trillion deficit. It's like 10% of GDP. That's very high. Not quite 10. It's like 8% of GDP. That's still very very high relative to history. We've never gotten to 8% deficit of GDP outside of deep recessions. And yet here we are, even before a recession truly takes hold, and we're already at sort of emergency time spending levels.
Mhm.
So they're going to have to refinance this at much higher borrowing costs. And that creates kind of a debt spiral of deeper deficits due to borrowing at higher and higher interest rates. So that's why we see now the interest expense line item is, I think, going to be the second biggest line item on the federal, budget after Social Security.
What is it,
So
like 17% it might get up to soon? Something like that.
17% of what?
Of total government spending might be to paying interest on the debt, something
Yeah,
like that.
yeah, something like that. Yeah. $1 trillion versus about four and a half, I think 5 trillion of spending. So yeah, it's crazy. It's getting pretty insane. So traditionally, I would expect yields to go down in recession, but because this is a sort of a curveball, I'm not really sure. I haven't made up my mind as to where I think bonds are going to go. So because for the first time, we're going to have true price discovery in the bond market because right now the Fed's not buying treasuries; they're selling treasuries. So the private market is going to have to step in, or at least non-Fed entities are going to have to step in and be the buyers of U.S. treasuries. So we'll see if they step up in a big way, and if not, we could actually see for the first time a recession where yields actually go higher, or at least stay high, and not actually drop. So there is that part of a risk to owning bonds as well, because typically the trade would be long government bonds to seek protection in a recession,
Hmm.
but that might not work this time around. So just throwing that out there as a potential risk factor.
Yeah.
Um, So this is now the leading economic index by the Conference Board. It's been now in decline for 20 consecutive months. That's firmly at recession levels, um, and it's led by weakening credit growth and manufacturing new orders. This is an index that's made up of, I believe, eight or nine components, and they look at these things that start to turn ahead of the business cycle, such as credit and manufacturing new orders. 20 consecutive months. If we don't fall into recession, this would be the first time ever that index has been in contraction for that long, and we have avoided recession.
Hmm.
Um, Same thing with manufacturing. So we would have to have a crazy coincidence of multiple reliable leading indicators of recession fail simultaneously. So that to me is a bet that I would not be willing to take.
Yeah.
But the market currently is making that bet. Here's excess savings. So one of the bullish points that people make is that, well, look at retail sales. That's the lifeblood of the U.S. economy, and retail sales have been very strong. I want to point out that the reason why they have been strong is because real personal consumption, meaning spending in real terms, has outpaced personal income, real personal income. So the only way you can do that for a long enough time period, meaning you can spend more than what you earn, the only way that's possible is by drawing down your savings. So here we see a chart from the San Francisco Fed. They published this research late last year. We built up a massive, piggy bank post COVID, right? Because of the stimulus payments as well as other things like the moratorium on rent, and people were allowed to stay in their apartments without getting evicted, without paying. So multiple factors led to a massive rise in excess savings to 2.1 trillion at the peak in
Yeah.
August
Also,
2020.
the student debt moratorium.
Yes, that too. Yeah. So all of that contributed to a huge, cash cushion, which has now been drawn down almost entirely. And if you actually look at trend growth in personal savings, we had that huge, cushion built post COVID, but that's now been essentially evaporated, and we're now below trend growth in terms of total personal savings. And if you were to extrapolate this, then these excess savings are expected to be exhausted at some point in the first half of this year now. So while retail sales have been good, the fundamentals of those strong retail sales are not good because consumption has been exceeding income because of the fact that so many people have excess savings built up. What was contributing to that was the stock market bubble too, in 2020 and 2021, where companies that traded at 20, 30 times sales, not even earnings, but sales, and that entire bubble popped, after that. But this is what led to this massive surge in excess savings. But now we're now below trend, and we're going to exhaust this by the first half of this year. So I believe that retail sales now are at risk if you look at it. If you look at this as a leading indicator to retail sales, consumption
So
cannot
basically, they
exceed.
would be increasingly debt fueled, and
Exactly. Yeah.
and
But
why,
even that won't
while the buy
happen.
now pay later may not go away, it's a kind of a sign that the consumer is becoming increasingly debt fueled potentially.
Right. That's exactly right. Yeah.
That's a risk. Yeah. Let's go ahead and go
Yes.
to the next one.
Yeah. So GDP, GDP is another point where the bulls say, well, look at real GDP growth. It's been very robust, and that's true. It has been robust as of Q3. That was 1.9% real growth year over year, which is still good overall. It's right in line with where we were throughout most of the 2010s. However, if you look at underneath the surface, if you strip out now, GDP is an aggregate of consumption, investment, government spending, and the trade deficit. I believe that government spending and the trade deficit are non-cyclical components of GDP, which means that they move in their own, due to their own dynamics. They're not sensitive to the business cycle itself. So I think it's important to strip out the non-cyclical components of GDP with the cyclical components of GDP, because the cyclical components of GDP actually show you where industries are that are actually sensitive to economic cycles. And if you look at that component of GDP, which is basically defined as um, durable goods orders, um, residential investment, and business equipment investment. So these are subcomponents of the GDP report, which you can see from the BEA website.
Mhm.
That's now in contraction at minus 3.2%. So if you take the aggregate of those three subcomponents of GDP, we're in contraction, and they never enter contraction outside of recessions.
Mhm.
Um, as you can see here, the last time it went into contraction was 2007. Um, you know, 2000, actually, in the 2000 recession, it never went into contraction, but it did in the 1990 recession, it did in the 1980 recession, and it did in the 1974 recession. So each of
Mhm.
these last several recessions, cyclical GDP has given you the leading edge that we are, entering a recession, several months in advance of real GDP following. So here we
Now
are
let
with
me
that.
push back here. So the in the early '90s, was there a recession there in the very early '90s? Because if you just if you put all your full faith in this indicator of recession, this would have said a recession in the early '90s.
Yeah, so there actually was a recession in 1990, 1991.
Okay, all right.
Yeah.
So this one
I believe
seems
that's,
pretty foolproof.
yeah. I believe that's what it was Bush Senior that was president at the time, and I believe I believe he went back on one of his promises of no new taxes, and they raised taxes that year.
Mm-hmm.
And I don't know if that was the cause of the recession, but I know that there was a recession, and that's when he lost his reelection, to Bill Clinton
There was
at the
also,
time.
I think, a Gulf War, and maybe oil
Yeah,
prices spiked, and that
yeah,
maybe that hurt things too.
exactly. That
I
hurt
gotta
as
put
well.
my history hat back on.
Yeah, yeah. So yeah, there was a brief recession. It wasn't a terrible one, but there was a recession at that time.
Now, this heavy negative number, is this at all being influenced by the big decline? I don't know if there's a big decline in commercial real estate because of the whole problem with office buildings and work from home. Is that causing this to be hugely negative, or?
That's probably a contributor, but it actually looks at residential investment.
Mm-hmm.
So the component that I use is residential investment. So if you look at
All
the
right.
table, it's right here. So durable goods is what goes into it.
Okay.
Business equipment investment and residential investment.
All right.
Those three. So yeah, if you look at those three specifically, they give you a very reliable indicator of recession in advance of the headline number, following ultimately. Yeah.
Okay.
So again, if you're looking at it, real GDP, this is what most of the bulls point to, that we're tracking quite well at trend that we've been in for the last 15 years, and we're actually above trend now and accelerating, which looks great. But again, if you look at what's building beneath the surface,
Mm-hmm.
again, real GDP can be obfuscated by government spending and also non-cyclical sectors like healthcare and education. Remember, they are not cyclical the way that durable goods or manufacturing are. So GDP can be masked. What's actually happening beneath the surface can be masked by increases in government spending. Not to say that government spending can't actually boost GDP. It does. Quite obviously, it does.
Mm-hmm.
But it can't prevent recessions forever. It would require an increasing amount of government spending to get that incremental ROI um, of that government spending to then stave off a recession. So unless if you keep doing that, keep at it for bigger and bigger amounts,
Mm-hmm.
then we could theoretically avoid recession, but then you destroy the currency at the same time.
Where
Um,
my mind goes, I have a bit of ADD, is that there's been an underinvestment in building homes in California, other places across the U.S. Homes have become increasingly unaffordable. That's my opinion. Um, maybe this is a time to be investing more as a country in home building, or when that residential investment, is that just home building and potentially apartments? Is there more
yeah,
to it?
yeah, exactly. Yeah, that's exactly right.
Okay.
And that's been in contraction. With the rise of interest rates, you can see that that's really gotten hit hard.
Mm-hmm.
So that's probably the bulk of it. But you can also see that business equipment investments have also started to decline in the most recent quarter. That's going to start to accelerate, I believe, in the coming in 2024, because remember that is essentially capex. Um,
Oh yeah.
That's corporate capex right there.
Mm-hmm.
So, and we've already started to see surveys show that companies are planning on big capex cuts this year. So again, this is a kind of a obviously GDP is a lagging indicator, but if you look at cyclical GDP in terms of these three subcomponents, it
Mm-hmm.
makes a lagging or at best a coincident indicator into a leading indicator, as you
Mm-hmm.
can see here. Now, the other thing that I wanted to point out is that gross domestic income, which doesn't get anywhere near the amount of press time and discussion, is not confirming GDP at all. We have very strong GDP growth, but essentially zero to negative GDI growth. Now, GDP and GDI are supposed to be equivalent. The difference is that GDP looks at production value, and GDI looks at what income is actually being generated by companies and businesses across the country. So income is flat to negative right now. And the
This
only time,
confirms what you said about S&P 500 earnings not growing.
right? Yeah, exactly.
All
That's
right, let's
exactly.
go to the next one here, Mayur.
So yeah, the relationship between GDI and GDP only deteriorates during or around recessions. So here you can see the ratio of GDI to GDP. So while GDP is very strong, GDI is not confirming that. And you can see that the relationship breaks down typically, not all the time, but typically during recessions. And it definitely did in 2020 and it did in 2008.
Mm-hmm.
In 2000, we were at a much higher base, but it did decline during that time. Never went below 1, but the decline was still there. The rate of change was there year over year.
Yeah.
So again, we're seeing a number of things happen that doesn't typically happen outside of recessions. GDP plus is another indicator that's published by the Philly Fed. This is still in positive territory, but again, nowhere near what real GDP is telling us. And this is actually a substitute to GDP. So they're not even trying to make this a leading indicator. This is just as good as GDP is. And GDP plus is much lower than what the aggregate real GDP is telling us.
Mm-hmm.
So again, this typically doesn't happen outside of recessions. Now, here comes the other big thing, employment. So jobs have been very strong, which is very true. While headline job growth has been strong, again, just like what we did for GDP, if you look at cyclical employment, that undercurrent is weakening very quickly. So here is a chart of cyclical payroll growth versus aggregate payroll growth. So basically what I did here is I went through all, 30 or so, 30 or 40 industries that the BLS reports on the monthly jobs report.
Mm-hmm.
And I basically just picked out the ones that are actually valuable in terms of showing us cyclicality in the business cycle. So these are industries like trucking, plastics manufacturing, garden equipment manufacturing, farm equipment manufacturing, um, temporary help services, which I have a separate chart of. These are all subcomponents of the jobs report by industry that start to turn ahead of the business cycle. So as you can see here, the aggregate of those, and there's 11 of those such industries that represents about 25% of all US jobs. You can start to see that that number goes into contraction 3 to 6 months in advance of the headline number, similarly going into contraction. And here we see that we're now down to 0.4%. So we haven't yet inflected there, but I believe that we're going to get there by February or March or maybe April at the latest. As you can see, the trend is very clearly in that direction. So if this starts to move up again, I'll definitely revise myself and say that I was wrong. But I believe that the trend continues to show deterioration here. And this is
So,
updated as of December.
so for people that have trouble with colors, the cyclical employment is on the top. And what I'm also seeing is when it crosses below that total employment, that's typically bad news. And
Right,
that's what it did back in 22.
right, exactly. So these are a collection of industries that are very sensitive. They have their pulse on economic conditions, like trucking, for example. You know, trucking companies are quick to adjust headcount based on their order flow. So if order flow is weakening, they will slash jobs very quickly to react to that. So these are industries that are very, very quick to react to changing market environments, and that's why they have predictive power with where we are at in the business cycle. So if this number, again, the crossing is the first concerning data point, but if this enters contraction, again, we never enter contraction in cyclical employment outside of recessions.
Mm-hmm.
So again, if this continues, we're going to get to that level. So again, this is um, sectors outside of government, education, and healthcare. So we have to make that distinction because government, education, and healthcare are not sensitive to cycles.
Right.
You always see growth in healthcare, you always see growth in education, and you typically always see growth in government. Um, so that's not meaningful from an analytical standpoint. So if we strip those out and just look at those 11 industries, um, that gives us a very important data point. So temporary help services is an example of one of those 11 industries that I have in there. And here you can see how this contracts. So this is when companies hire full-time employees, but on a temporary basis, like a 3-month contract or a 6-month contract. And it stays, bullish during bull markets. As you can see, it rarely ever goes into contraction for a long time outside of recessions. And here we are again, below zero. And typically, the only times this goes below zero is either in recession or right before one, with a lead time of about 6 to 18 months on average.
Mm-hmm.
So it's already been, more than 12 months now since that's happened. So again, we're getting close to that level. If these indicators don't turn around quickly, then the risk only increases that recession is becoming more and more likely. Here's permanent job losers. This is another piece of the monthly jobs report that's published. And every time this crosses over, this is a little bit of a different methodology, but every time it crosses over its 2-year moving average, the 24-month EMA that I have here, that's been a very reliable indicator that we're about to enter a period of heightened unemployment. So far, the bull case has been is that everybody has jobs. As long as everybody has jobs, the economy continues to do well. Well, that theory is now being challenged. As you can see here, we just got that crossover versus the 2-year moving average. So I believe, again, within the context of everything else that we talked about, it makes sense for joblessness to start to rise. If companies start to cut capex, if if credit starts to deteriorate, which it has been, if delinquencies start to rise, if all these things are happening simultaneously, it makes sense for unemployment to also follow. Remember,
Mm-hmm.
unemployment, typically stays low even through the very thick of recessions. We've seen that. Like if you look at the unemployment rate, it stays low until it suddenly isn't low anymore, and you don't have a whole lot of time to react to that. Um, so you have to look at leading indicators of it, such as,
Yeah,
the
that makes sense because in a recession, businesses aren't hurting as soon as the recession starts, but as it goes on, then they start to hurt. Then they have to let go of people. So that,
Right.
that makes sense that there's a bit of delay of sorts.
Right. Because it makes sense. Right. Because like, think about it. If you're running a business, and you see, okay, well, things are getting tougher where earnings drop 10%, you're not going to make wide scale cuts to your workforce on a 10% decline.
Yeah,
But if it starts to get worse, 10% becomes 13%, which becomes 15, then you start to make the decision. So that happens on a delayed basis.
yeah, that makes sense. All right, let's
Um,
keep going.
yeah. So jobless claims, again, that hasn't crossed over yet, but I believe, again, within the context of everything else, that's moving up and it's at a 2-year high now. So again, analysts are expecting 12% earnings growth this year, but I think, again, the leading indicators of earnings suggest that these expectations are way overstated. I believe that these earnings estimates are going to be marked down. Um, Recessions are always slow buildup of things. But also, the other thing that started about a year ago was the banking crisis, the regional banking crisis, and this is another big part of my bear thesis, is that
Yeah.
they continue. They're still not out of the woods yet. Earnings have not turned back up for banks, especially regional banks. So they have huge unrealized losses on their treasuries still. They have depositor withdrawals because, again, banks can't pay high interest on their deposits. And so people have been leaving, banks to park money into money market mutual funds, which pay 5% right now, which is a no-brainer for everybody to do. So they're dealing with, withdrawals while they have huge losses on their unrealized held to maturity securities. Declining commercial real estate prices, banks have huge exposure to this area. And those prices have gotten clobbered and shows no signs of recovery at this point yet. They're also posting rising loan loss provisions as credit starts to deteriorate, as credit quality deteriorates. So all these together leads to tightening credit availability, which again
Mhm.
hits earnings at the margin. So here's a chart of total deposits at banks. You can see that that has gone down quite a bit. It has stabilized since for about a year now, but it certainly hasn't gone back up. And banks need that, to generate credit as well as create additional reserves that they need. Um, but loan loss provisions are rising. And as you can see, it is reaching levels that we were at during COVID. Um, not quite to the highs yet, but the rate of change again is up, and that typically only happens in and around recessions as
Mhm.
credit quality starts to deteriorate. So the net result is tightening credit availability. This is a survey published by the Fed that showed that 50% of respondents um, at banks are tightening credit standards for their commercial and industrial loans. 50%, you never see that outside of recessions. Again, 2008, 2020, 2000, 1991.
Mhm.
Yet another indicator that we're in or very close to being in a recession. And bank lending rarely contracts outside of recession. This is showing total bank credit year over year growth. That's now in contraction. That never happens outside recessions. Delinquency rates beginning to rise. I've actually forgot to paste the chart here, but you can actually see this chart. You can just Google delinquency rates, Fred.
Mhm.
Just type in that Fred, FRED, delinquency rates, and it'll show you a chart of that. It's starting to rise now, and it's at 10 to 12-year highs at this point. So people are starting to default on credit card loans. That's usually not good for bank earnings. And here you can see earnings estimate revisions for banks are deeply negative and have not recovered at all. At this point, analysts expect bank earnings to be lower this year than last year. Again, so this is not bullish, and these things have not yet recovered. So we haven't yet seen, I believe, the bottom in earnings for regional banks yet. Again, so this is not good for the aggregate economy because regional banks, provide loans that are needed for small and mid-sized businesses as well as commercial real estate. Without all of this happening, it's very difficult to see earnings growth at the margin. Then there's backlog. Backlog continues to telegraph a drop in CPI. We're getting CPI here real soon this week. But I think that that's going to continue to drop. We might see a month or two of rebound, but I don't think it's going to be meaningful in terms of the change, unless if we see backlogs start to rise again, which we haven't seen just yet. The Fed is, again, as we said, removing liquidity. So again, the Fed is very committed to getting inflation under control, and they're very clearly willing to do it while delivering, a hammer to the economy. Housing prices, again, they remain under pressure as they should, since rates have risen so much. Again, this is all bearish for earnings. Prices dropping is good for buyers, right? That need to buy a home. But remember, we're talking about markets and equities, and this is bearish at the margin for earnings growth year over year. Real retail sales down again. Now, this has actually bounced back a little bit in the most recent period, but overall, it's because we're going off of this high base. So I will concede this fact here, that even though this looks bad, it's not as bad as it looks because we're off of a very, very elevated, base coming out of the recession. So the math, kind of tricks you if you're looking at it, without putting that into context.
It's the effect of the stimmy check, right?
Right. Exactly. But as I said, because excess savings are being drawn down, I do think that retail sales are going to slow down quite significantly in the second half of this year. So we'll see if that comes to pass. All this is happening while unemployment is low. It's still low. The BLS is revised down. Basically every month's jobs figure this year in 2023. So I think that's going to continue. And
so let's go back to the unemployment a second. So
yeah,
typically unemployment bottoms right before recessions.
that's correct.
So that's how you want to look at that one.
Right.
That's the uncomfortable truth.
Yeah. So what does this imply? The S&P PE is much higher today than it was in previous 5% interest rate environments. Here you can see a chart of the Fed funds rate versus the S&P forward PE multiple. And it's actually even higher now. This chart was actually updated. Actually, I should have updated it for this presentation, but it was back in September. But we're closer to 20 now with no other changes to the Fed funds rate. We're much closer to 20 now. And the last time we had a 5% interest rate was back in 2006. And you can see what the multiple was back then. It was closer to 14 to 15 times. So, for the same interest rate environment, we're at a much lower PE multiple than we are today. And at the same time, we're on lower growth expectations too. Remember, we didn't have earnings growth at all last year. Whereas we actually had earnings growth in 2006 of somewhere around 7-8%. So we had a lower PE on better earnings growth back then than we do today. So I think that, what's happened here.
That argues that we're the market's overpriced.
Right. That's exactly what it argues, is that I think the reason why that has happened is because there is a very large wager being placed that we're going to have a soft landing.
Yeah.
And I think that that's a risky bet to make, especially because so many leading indicators are not saying that. If some of these things start to turn around, I'll be the first one to say I was wrong, and it is actually a soft landing that's happening. But that's not what credit is telling us. That's not what manufacturing is telling us. That's not what cyclical GDP is telling us, or cyclical employment is telling us. These are leading indicators of earnings, and they're not moving in the right direction. So, and then a little bit of valuation, where the free cash flow yield is now much lower than the 1-year Treasury yield. And that typically doesn't happen. The last time this happened was, again, 2006, 2007, where it was not a good idea to own stocks at that time versus bonds. And now, we see a 1-year yield of 5.25%. So the only way that stocks outperform bonds here is with earnings growth.
Right.
And right now, I don't see that happening. Here, just a little bit of anecdotal evidence. This is just a publication from the ISM. There's concerns relative to the slowing economy, sluggish demand. Here you can see, another anecdote from FedEx. They've actually been warning about recession, for a year, for almost 6 months now, beginning in June. And FedEx is important because they have a pulse on domestic shipping. Shipping volumes have been declining, and they think that it's going to be, marked by demand challenges through 2024, at least the first half of 2024, maybe longer. Maersk is the largest shipping company in the world. They're flat out telling us that they're expecting recession in both Europe and North America. And you think that Maersk has a pretty good pulse on volumes, right? On shipping volumes. And that's a direct reflection of economic growth or lack thereof. Even American Express is showing, increasing total bad debt provisions. So they're expecting some increasing credit risk here, which they really shouldn't, because they don't take on a lot of credit risk to begin with. But even they're starting to increase, their bad debt provisions. These types of increases only happen around recessions. As you can see, the rate of change is up during 2008, during 2020, and right now. So I think that overall the market is overvalued by 20%. Actually, I think it's even more now. I have a very, very deeply bearish view. I think the S&P could go down all the way to 3,100 to 3,200. And that's just pricing in a garden variety recession, not even a 2008 style recession.
And is that about a 33% drop or so? Or
yeah, roughly speaking, yeah, from today's level. Because
Okay.
all I'm saying is that if we get to a 15 PE on $210 of earnings, which is basically, no growth year over year. It's just flat growth year over year. And a PE of 15, then that takes us all the way down to about 3150 on the S&P. So that's quite a substantial decline based on a very modest recession scenario, where 15 PE is typically average for a recession. In fact, it might even be slightly high for a recession. So the Shiller PE is another way of looking at it, but it could be that forward 5-year returns may be very lackluster based on where we're at in the Shiller, the CAPE yield. Another sort of indicator that we might be in for a rocky 5-year period from today's levels going forward. So basically, my conclusion, my summary is that it's the direction of leading fundamental indicators at the margin that implies negative pressure to S&P earnings. So right now, analysts are still very bullish on earnings, but directionally speaking, where credit is going, where manufacturing is going, where employment is going, where the cost of capital is going, directionally, this is bearish on earnings growth year over year. So I believe that analysts are going to mark down fiscal year 2024 estimates quite substantially. And yet at the same time, markets are priced for robust earnings growth at a forward PE of 18 to 20 times right now. So that's a dangerous combination in my view, because if that doesn't happen, if we don't get that soft landing, then there's going to be a substantial drawdown in the equity market. And so I think that's already begun. We've basically gone 2 years with no returns on the S&P. Even though we had a strong return last year, it was just a rebound of the bear market that happened the year before.
Yeah.
So, it's a dangerous combination that the market is pricing in a very robust earnings recovery. And if that doesn't happen, especially because fundamental indicators are showing the opposite, then there's big risk to the downside, in my view, for the market. So that is my entire spiel. um,
So this may be one of the longest videos we've done, but you presented some fantastic information. Definitely got me a little nervous about where markets may be heading. I want to push back on a few more things before we go. Do you? This is this one's a little more wild, but I want you to consider it. Is it possible the decline in 2022 wasn't just a reaction to the Fed, but was more the market's forward looking toward a recession?
Yes, that's entirely possible. It's entirely possible that that drawdown in late 2022 was pricing in the earnings pause of 2023, and that the bull market of 2023 is pricing in the earnings recovery of 2024. So that's entirely possible. So I could be wrong about all of this, and we could have a meaningful year of earnings growth this year. But I don't see how that's possible without the assistance of manufacturing and without the assistance of credit. So, we have to see, manufacturing rebound. We need to see expanding work week hours. We need to see expanding cyclical GDP. We need to be seeing expanding cyclical employment. It's rare to see all of this in contraction while getting a bull market in earnings and in the economy. It would probably be a first time in history when all of those things have been happening while having expansion in the economy.
So, the federal government, the Fed, stepped in heavy during the health crisis. Really didn't let as many businesses fail as maybe should have. Would a recession really be that bad of a thing to kind of, cleanse the system a little bit, let some zombies die, and you move on from there?
Yeah, that's exactly right. And I think recessions are great. That's what recessions really should be, to serve as a mechanism to clear, companies that destroy value, right? Because if you keep propping up companies that don't add value, meaning their returns on invested capital are below the cost of capital for a long time, then these companies are consuming resources that really should be better allocated by others who can allocate them more effectively.
Yeah.
So recessions, clear out that excess, investment, the malinvestments. So that's
I
tough
think
for
there
the
were,
companies that go down.
yeah. I think there were a lot of hobby businesses that probably should have gone under during the health crisis, but were supported right away. Where that business at best provides someone with a bit of an income.
Yeah.
All right, this is my final question. What do you think about a potential bifurcation in the markets? I know there was this rotation where all this money seemed to flood out of the Magnificent Seven, out of tech, and the rest of the market did much better. But we have AI increasing profits. We have companies, greatly increasing their profits because of AI
Mhm.
in the tech sector. Um, is it possible we have this continued bifurcation, this excellence with how the tech companies are doing, um, and that be in stark contrast to your boring businesses who only grow with the economy?
Yeah, it's possible, but you also have to ask the question about valuations too. At this point, the Nasdaq trades at a 30 PE, which is again
Mm-hmm.
is high even for the Nasdaq. On at the aggregate. So yeah, certain companies may do better than others, as is always the case. So our job is to pick those companies and identify them and own them. Um, but you can have a case where company executes well, even shows earnings, strong earnings growth, but the stock suffers because of valuation compression.
Mm-hmm.
So that's the main risk that I see right now is valuation for the
Or
Nasdaq.
people just sell everything because they're scared, right?
Right, right, yeah. So right, assets correlate to one during liquidations. Um, but yeah, that's regarding the point that you made on zombie companies. I saw a chart showing that uh, zombie companies, meaning unprofitable companies, now make up 16% of the Russell 3000,
Mm-hmm.
which takes us back to the highs of the dot-com bubble.
Wow.
Um, so we have a lot of zombie companies out there still in existence. And with this increase in the cost of capital now, and again, like you said, the Fed knows what they're doing. They see this happening and they understand that there's too much, malinvestment out there. That's one of the contributing factors to inflation. They need to clear this out.
Mm-hmm.
And so by raising the cost of capital, you're seeing capital markets close for many, many companies who are unable to generate profits, or at least self-fund to a minimal level. So at the margin, again, even if it's not Nvidia or Google or Microsoft or Tesla that gets affected, even if these 16% of zombie companies, if even half of them, close their doors, again,
Mm-hmm.
that's at the margin very bearish for earnings for even for the S&P 500, because these are customers of S&P 500 companies. Their employees are spenders at S&P 500 companies. So when companies close because capital markets have closed, at the margin, it is a net negative to earnings, even for much healthier and well leveraged companies out there that do add value to society.
Awesome. Well, thank you very much, Mayur. I think what's interesting about Mayur is he's a growth investor, but he's here talking to us about recession. You made a very compelling case and argument. Full disclosure, Mayur does have a personal bet against the NASDAQ that he has disclosed on X. Also, disclosure, we use Zach's investment research for helping us screen for individual stocks. We're not getting any kind of discount or benefit for having this, though. But I did want to let people know that full disclosure. Um, yeah, I think this has been very helpful, Mayur, and thank you for this. I realize it's a long video, but the right people who are interested and have open mind, I think, are watching. Um, I don't think people should necessarily do anything with their money based off of this. I think it can be hard to predict, and it can be hard to time. So like now might be a good time to trim. Like you don't want to trim suddenly like after the market's down 20% and the the media is talking about recession. But it just depends on what you're trying to accomplish with your money. The hard part is if you trim now, you need to buy later at a lower price to actually benefit.
Right.
And I think that's the tricky part for investors. So I think in general you want to be with companies that have some strength to them, that are where the fundamentals have been improving, where if for some reason the capital markets do get closed or restricted in some ways where it's harder to borrow, that your capital is with companies that are making progress and have the confidence of investors to be able to raise money if they need to. So if you have money with companies that are perpetually raising cash, that may not be a good idea. What are your thoughts on those little tidbits, Mayur?
Yeah, I completely agree. So the way I do it personally is I still own, Tesla. I do trade a portion of my shares, more like swing trade a portion of my shares. So currently, the way I do it is I keep 2/3 of my position no touch, and 1/3 of my position I trade, which I post on my other X account, TSLA_trader.
Mm-hmm.
And but beyond that, all I did, as a result of this entire framework of thinking, is buy a put spread on the Qs, on the QQQ, basically a put spread that expires in June of 2024 to hedge the portfolio. The VIX is so low right now that bearish options bets are very cheap. So the payout is quite lucrative. I locked in at basically a 30x return if the Nasdaq has a 30% decline by June. So the net cost of that put spread was roughly $1, and the intrinsic value of that put option, of that put spread, would be $30 if we have a 30% decline in the Nasdaq between now and June.
Mm-hmm.
So that payout is quite lucrative. Again, not recommending you own it or buy it, but that's just what I'm doing, what I've done personally. So as a disclosure, that's how I've acted on my overall
And this
thesis
is
here
expiring June of this year,
expiring
or
in June
okay,
of this year of 2024.
all right. So you bought a little insurance, and
Yeah,
what you don't have to
but I
disclose this,
still
but what
own
percent of your
very
portfolio did you?
substantial. No, it's probably about a 3% allocation.
Okay. Mayur is at Fresh Jiva on X. Mayur Thaker, equity strategist at Zacks Investment Research. And I really appreciate this. We're going to go ahead and end it now. Thanks, and bye for now.
All right. Thanks, Brad.